Hello and good day. Welcome back to our class. This is teacher Onin Guzman and our topic for today is Receivable Management Tools and Techniques for Business Finance. If we will get the aim of receivable management, it aims to design policies regarding the granting of credit and collection of receivable with high consideration of costs, risks, and benefits. So a trade-off exists between benefits and costs. The objective of receivable management can be clearly understood once the nature of receivable is fully understood. So the sale of goods or services on account services costs such as A. Administrative costs. So this is the cost in form of salaries of employees keeping and maintaining the records of the customers. Next we have the capital cost. It means that this is the cost in the form of interest once production is financed by creditors or as opportunity cost if financed by internal resources. Then we have credit and collection costs, meaning to say this cost incurs during the extension of credit and collection of receivable. Then we have the default costs, all costs related to the receivable that could not be collected. Example, administrative capital, credit, and collection costs, including the cost of goods sold. In other words, selling of selling goods on credit poses to the business and at the same time incurs additional costs. Despite these two negative effects of having receivable, why do businesses have to sell their products or services on credit? To answer the question a while ago, so the following are common reasons for the sale of goods and services on credit. So letter A is to increase the sales volume. B is to improve profitability level. At the same time, we would like to increase the market share. Also, to entice new customers and retain old ones. And finally, to become competitive in the market. Let's move on to receivable management technique. So the receivable management techniques focus on the formulation of policies relative to the following two basic phases of receivable. So we have the granting of credit and the collection of receivable. So the first one is okay on the policy on granting of credit. So take note that we will have what we call credit standard. And here we have two types of credit standards. We have either the liberal credit policy or the optimal credit policy. So here, if we say liberal credit policy, so somewhat this is relaxed, sales have a possibility to move up, the average collection period may be longer, and the investment receivable is large, and the cost of collection is high. On the other hand, if we say the optimal credit policy, the chances are credit is steep or stringent, the sales volume may be down, the business usually experiences a short collection period, then we have there is a lower incidence of delinquency and default. And finally, the cost of collection is low. Let's take note that the credit standards are the basic criteria or the minimum requirements for extending credit to customers. So in providing credit to customers, the business may adopt the following basic credit policies. So again, as we discussed, we have the liberal credit policy and the optimal credit policy. And take note that the credit standards, it is the guidelines adopted by the company when determining or accessing or assessing potential credit customers. Credit customers are usually evaluated using the 5 C's of credit. So the first of which is the character. It means the reputation and the track record of the customers. Then we have the capacity. So this is the ability of the customer to pay. Then we have the collateral. It is the type and kind of assets being pledged as guarantee for the credit. Usually, this is the land title or of course, ownership of building. Then we have the capital. This is the financial position of the borrower. And finally, the condition, it means that the market and economic conditions of the business where the borrower belongs. Again, talking about the policy and the granting of credit in terms of the credit terms. So it refers to the standard of or negotiated condition offered by the seller to the buyer of goods sold on credit. So we are looking into three. So the first of which is the credit period. So this is the length of time granted to the customer before the scheduled payment due date. Also, the discount period, it means the length of time that a customer can avail, okay, the cash discount. And of course, the discount is the amount deducted from the invoice price of goods once the payment is made within the discount period. The other major piece of receivable management is the formulation of a policy on the collection of receivable. In this stage of receivable management, the two questions that must be answered are the following. First is, how long will the receivable to be collected? And the other one is what action will be taken in case of customers default. So the first one of which is the collection effort and program. So we have actually the monitoring of receivable. Usually starts after making the credit sales and ends up upon the collection of the account. So let's look on this table. So we have the aging of receivables. We have the following name of customers. So we have Christine, Johannes, Nicholas, and Carl. Then we have not yet due for 1 to 30 days. We have 100,000 for Christine, 100,000 for Carl, and the total is 200,000 pesos. For 31 to 60 days as overdue, we have 80,000 for Johannes, Nicholas as 20,000, and the total is 100,000 pesos. While for the overdue for 61 to 90 days, we have 100,000 for Nicholas, Car as 20,000 at a total of 120,000. While for overdue for 91 days and over, we have a total of 80,000 pesos. So take note that preparation of aging schedule, okay, may also assist the business in determining the expected amount of doubtful or bad debts account. So based on a certain percentage from the previous year's experience, example, so the business assigns a percentage of bad debts. For example, we have for 31 to 60 days overdue, we have 2%, 61 to 90 days overdue is 5%, and 91 days and overdue is okay, 10%. So the estimated amount involved in these bad debts of the business is computed as follows. So for 31 to 60 days overdue, that is 2% of 100,000. So we have here the 100,000 pesos, right? So that is equal to 2,000 pesos. While 61 to 90 days overdue, that is 5%, with a total of 100,000 for 61 to 90 days, as we can see on the table. So the allotted value is 6,000 pesos, while for 91 days and overdue, that is 10% of 80,000. So that is why we have 8,000. And the total of amount of bad debts is amounting to 16,000 pesos. So to facilitate the monitoring of receivable, the individual ledger of customers have been complete, uh, should have complete information such as mailing address, contact details, classification, whether the customer is old or new, and the maximum credit amount allowed. So after you monitor your receivables. So the next step on collection effort and program is the sending billings. So bill or an invoice is a business document covering the transaction issued by the seller to the buyer. It usually includes the product, quantity, price credit terms, and other important details. So the time of sending the bill must be clarified with the customers, most especially if there is a cut-off date. Next is the charges on overdue account. So charges or interest are only imposed once the payment of a customer is late, unless otherwise stated. So no interest should be made if the payment is made within the credit terms. And finally, of course, so we have the delinquency and default. So this is the last resort or the last remedy and assuming that all possible ways to collect the amount have been exhausted. So the business can resort to legal action. So let's have what we call the marginal analysis on credit policy. So we have here the following. So adopt the proposed change in credit policy when incremental profit contribution is greater than incremental costs. Or we have here reject the proposed change in credit policy when incremental profit contribution is less than incremental costs. And letter C is retain the existing policy when incremental profit condition is equal to incremental cost. To demonstrate the marginal analysis on the credit policy, so let's consider problem number one. So all sales of the cruise company are made on credit with the term N over 30. The business on an average collection period of 90 days. The current annual credit sales of the business is 12 million. Cruz considered changing the credit policy by offering the credit terms of 1 over 10 and over 30. With the proposed change, the company expects that 80% of the customers will avail themselves of the discount, and the collection period is expected to change to 60 days. So the opportunity cost is 10%. The question is determine if there's a need to change the credit term. So to answer the question whether there's a need to change the credit terms, so let's consider our answer here in the tabular form. So as you can see here, we have the proposed credit terms of 1 over 10 n over 30 against the present credit terms of n over 30. So let's look first on the opportunity cost on receivable. Based on the proposed, since we can faster this one or we can increase the expected average collection period from 90 days, we can shorten this one into 60. So approximately there are 360 days in a year. So that is actually we will have our average collection of 6 times a year. And there are 12 million divided by 6. This is equal to 2 million. So meaning to say each collection period is amounting to 2 million. But take note there's an opportunity cost of 10%. So that is why 10% of 2 million is 200,000. So we have the proposed credit terms of 200,000. Now, on the other hand, on the presence, we have 90 days as our average collection period. So meaning to say 360 divided by 90 is equal to 4. So we have 4 collections in a year. And take note that 12 million divided by 4, so we have 3 million collection, 3 million pesos per collection. So take note that there is 10% collection opportunity, or what we call this one as opportunity cost of 10%. So that is 3 million times 10% is equal to 300,000. So this is from our present credit terms. However, on our proposed credit term, we are offering cash sales discount of 1%. And based on the given, so the company expect that 80% of the customer will avail themselves of the discount. So it means that 12 million times 80%, this is equal to 9.6 million. So take note that, so we will remove this or we will have actually 9,600,000 times 1%, so we have 96,000 pesos. So to sum up, our proposed credit terms is 200,000 plus 96,000. So we have 296,000 in all. On the other hand, the total of the present credit terms is equal to 300,000 only. So since the cost of 296,000 under the proposed credit term is lower than the cost under the present credit term of 300,000, so Bruce may change his credit terms. So that ends our discussion on receivable management tools. Again, this is teacher Oni de Guzman. Do not forget to subscribe to my channel so that you will be notified about my new videos. Thank you.